This week, retirement just became much more expensive. Here's why. Welcome back to the Industry Leader Update. Thanks to runaway inflation and rising interest rates, retirement just got a whole lot more expensive. This also makes extracting home equity more costly. Personal financial columnist Rob Carrick writes in the Globe and Mail, "There are a couple of ways to squeeze out additional retirement income out of your house. One is to get a home equity line of credit. As we mentioned on this show just last week, HELOCs are very likely to disappear as home values eventually fall. After all, why would a bank want to take the risk of lending money on a depreciating asset? It's the cold calculus of banking. Many retirees are now going to have to find alternative sources of cash flow or be forced to liquidate some of their assets in order to maintain their current standard of living, that amid inflation and rising interest rates. And those that have a significant credit card balance outstanding are going to see their minimum payments increase each month or fewer of their dollars paying down their principal balance. Older Americans that do want to tap into their home equity could find that HELOCs are no longer a viable choice, that thanks to higher interest rates, or simply that HELOCs are no longer available. And those considering renting after they sell their home may want to reconsider their options. The average rental price in the U.S. surged an astounding 19% from December 2020 to December 2021. A better option, even at today's inflated home values, may be instead to utilize a HECM for purchase and then place a significant portion of their home sale profits as a down payment, then keep the rest for a rainy day. While home values are precariously perched on a record high, rising interest rates are beginning to erode the proceeds that are available to new reverse mortgage applicants. Just this April, the 10-year constant maturity treasury rate increased by nearly 60 basis points, and that rate is likely to continue to spike higher as the Federal Reserve just raised interest rates by a half percentage point in the attempt to suppress the fastest surge in inflation in over 40 years. Both home sellers and buyers will feel the brunt of the Fed's announced accelerated reduction of their mortgage-backed security purchases by $35 billion a month by this September. And the Fed's plan to reduce their balance sheet will put pressure on both the housing and financial markets. Lower home values, of course, directly impact reverse mortgage eligibility or the benefits received, and the financial markets will likely cool after a decade of massive quantitative easing and low interest rates. Now, what are the lessons to be learned? First is that home equity is neither secure or even real until it's separated, either by sale or by loan proceeds. Second is that procrastination is perhaps the worst or the most costly mistake today's eligible homeowner can make who could benefit from a reverse mortgage. And third, while the reverse mortgage was never merely a loan of last resort, it may provide a much-needed relief for retirees of all income brackets. What are your thoughts on the increasing costs of living in retirement? Leave your thoughts in the comment section below. And also, if you'd share this video on your social media platforms on Facebook, LinkedIn, and Twitter. Don't forget, we have a YouTube channel, HECM World. You can subscribe and then hit the notification bell. That way you never miss an upcoming episode. And each and every week, you can catch our podcast, HECM World Weekly. If you're an Apple user, you can find us on iTunes and subscribe, or go to HECMWorld.com if you're not there already and subscribe as well. You can get the latest reverse mortgage news, analysis, and commentary each and every week, no matter where you are. Thanks again for joining us. Until we return, have a great week.